when you think about it, if you have a unit and you're doing a major reno on it, it's down and not available for rent for a longer period of time. So I agree with your approach about trying to improve the operations on the margins without having to totally rebuild the building. And as you know, it costs a lot to get contractors and work done. Anybody who's ever remodeled their house and spent 50,000 on their kitchen, they understand things are expensive. So
welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today's conversation takes us from the Silicon Valley to Austin, Texas, and into Greenville, South Carolina. For those of us not from South Carolina, we would say Greenville, South Carolina. But what a wonderful conversation, learning more about the journey from single family into multifamily and why in the Carolinas. If you're like me, you're probably hearing a lot about the Carolinas, especially in the Greenville area. What's going on there? We're going to dive into that in today's conversation with the guest who has over 46 years experience in the real estate industry, founded Spark Investment Group in 2020 and transitioned his single family portfolio into multifamily properties. And now they have almost 1,000 units managed as general partners, upwards of 128 million in value of GP properties. So everybody, please welcome Arn Cenedella to the show. Hey, Arn, welcome to the show. Here we are, very interesting piece. We are both sitting in South Carolina. So in the time we're recording this, it is a tropical storm moving through the area. It hasn't gotten out there to the west side of the state. But Arn, welcome to the show. How are you doing today?
Hey, Brett, pleasure to meet you. Happy to be here and look forward to having a nice conversation about investing in real estate and maybe particularly in the state of South Carolina.
Yeah, that's awesome. So tell the listeners just a little bit about who you are, Arn. What's your professional background?
Yeah, great question. So as a kid, I loved math and science, went to college, Colgate University, grad school, University of Michigan, ended up with a master's in physical chemistry, thought I was going to be a professor or a research scientist, but decided that wasn't for me. I grew up in the San Francisco Bay Area. And my father had a residential brokerage business in Menlo Park, which is right next to Palo Alto, so kind of right in the heart of Silicon Valley. And I was probably 23, got my master's, moved back to California, got in residential real estate March 1978, and have been doing that my entire adult career, and moved to Greenville, South Carolina, where I am now 10 years ago in 2014.
Moved to Greenville from California. And when you were investing in California, did you make that jump to the Sunbelt area while you were still in California?
I actually made the jump to Austin, Texas. So I was very fortunate to do that in the early 2000s, started investing in Austin. And it's a great question because when I first got into the real estate business in the San Francisco Bay Area back in the late 70s, early 80s, you could actually buy single family rental properties that made some kind of economic sense from a cash flow point of view. Of course, we know what's happened to prices in homes in Silicon Valley, and so the rental game doesn't work very well. So at a certain point, I got on to Austin, and, it had a lot of the same drivers, tech, et cetera, big university, and I started investing there. And then when I moved to Greenville, South Carolina, I kind of moved all my equity to Greenville, which, as you know, is between Charlotte and Atlanta. So it's definitely a booming region, and it's proved a lucrative place to invest.
Yeah, and Greenville itself, so just from the outside looking in, definitely some appreciation happening there, right? And there are these little pockets around. So there's Greenville and Spartanburg, right? And these other pockets right around that area. But there's also Clemson. That's not too far from there as well, too. What is it about Greenville or here in the South, Greenville, when you say it like that, what is it about Greenville that you like as an investor?
Yeah, so there's a diverse economy. As you know, BMW has a major facility in Greenville, Spartanburg, and every X car BMW makes in the world is built in Greenville, Spartanburg. Sounds weird, but it's true. Michelin has their North American headquarters here. And so those are two major employers here in the upstate. And then in addition, you have all these smaller manufacturing companies that support these larger auto manufacturers. So the auto industry is one. General Electric's here. They build turbines. Lockheed is here. The other thing is, since we're on the I-85 corridor, and you know how busy that is living in Rock Hill, it's a great place for logistics and transportation and warehousing. Basically, we're halfway between Atlanta and Charlotte. And then I think the other factor would be downtown Greenville is a fabulous, vibrant, walkable downtown. And so there's a lot of attraction that way. And many Northerners from New York, Boston are relocating to the Carolinas, as you know, but specifically Greenville. And so, of course, they bring income, wealth, economic activity, which kind of helps make the whole thing go.
Interesting. And with this appreciation that's happening there, I guess before I even get to the appreciation part, the taxes. How are the taxes in Greenville, and how does that affect the investments? And I know that, the multifamily is just a little different from the single family. Can you speak to either sides of that, how the taxes affect that investment?
Yeah. So I hate to say it as a South Carolina resident, but the property tax system as it relates to owner-occupied property versus investor property is a little strange. And the upshot of it is property taxes for investors are significantly higher than for owner-occupants. So it's not a deal killer. It's just when you underwrite the deal, whether it's a single family or multifamily, you have to take into account the tax structure. Most of the counties have online calculators, so it's easy enough for an investor to estimate what the new property taxes will be. South Carolina reassesses upon sale. The other thing that's nice that I'd encourage South Carolina investors to look at is there's something called the 25% ATI exemption. And just Google it. You'll see the info. Most counties have a form online, 25% ATI. And I think the ATI stands for assignable transfer of interest. What it effectively does is allow investors to reduce the assessed value of the property 25% from purchase price. So you are actually able to reduce property taxes a little.
Interesting.
Yeah.
Very interesting.
Yeah. Check it out. Yeah.
25. You said it's 25% ATI?
Yes.
Okay.
Just Google that. It'll pop up pretty readily. Yeah.
Amazing. And now with this appreciation piece that's happening there, how is that affecting, difference from, say, this Greenville in 2000 versus Greenville in 2024?
Yeah, prices have gone up. So Greenville's no longer inexpensive. I live in a fairly nice, I'd call it upper middle income, neighborhood near downtown. And I would say homes now probably go at about $300 a square foot, where 10 years ago they may have gone for 100 and a quarter, 150 a square foot. So there's been significant appreciation. Greenville's the center of what's called the upstate of South Carolina, like as you noted, kind of the northwest part of the state, 9 counties, 1 million people. And so as Greenville's gotten more expensive, uh, people are moving to the surrounding areas. And I would liken it to where you are in Rock Hill. You
Yeah.
get the overflow from Charlotte. Charlotte's very much gone up in price, and so that pushes values up in the surrounding areas. So the growth and the appreciation from Greenville is extending out through the entire kind of upstate of South Carolina.
Yeah, yeah, definitely that build out, and you're 100% right. When we launched in the Charlotte market probably, I don't know, 5 years ago now, and buying houses less than 100,000, and not doing anything into them, making money on them. And we were talking in those times, or we were hearing in those times, you're not going to be able to buy a house for under 300,000, and that is definitely there. So probably similar to that Greenville growth in the areas around. So where does that push you and your team when it comes to acquisitions? Tell us a little bit about your target right now in that area.
Yeah, so I'm a multifamily investor after a long career as a single family investor. And I would say investing in single family homes is a tried and true way to accumulate wealth, build income, build passive income, and increase your net worth. So it's tried and true. And if you just systematically buy single family homes, trust me, you'll turn around 5, 10 years later and you'll be happy you did. I don't think anybody thinks the price of housing's going down. In my 46 years in the industry, it's generally gone up with occasional dips, and we're kind of maybe in a little bit of a dip now. So what I do now is buy small multifamily properties, primarily in Greenville County. My operational partner lives here. I live here. And as you know, Brett, I mean, real estate's very local, and you got to kind of know the territory, right? And it can vary dramatically from block to block, from mile to mile. There are areas that are improving, and there are areas that are maybe still having trouble. And as an investor, you kind of want to anticipate those areas that are improving, where house flippers are going in and investing and raising the value of the property, where old storefronts are being turned into a cool coffee shop, and all of a sudden that attracts a certain group. So when you're in an area and you can put your eyes on it, you get a little bit of a competitive advantage. So we only do deals in Greenville, South Carolina. And as you note, Greenville, and I would say South Carolina as a whole, is more of a growth market than a cash flow market per se. And in my own mind, you need cash flow to support the property, no doubt. But ultimately, I think the goal of real estate investing is to grow one's net worth. And as one's net worth grows, financial security follows. And at that point, you can allocate that capital any way you want to create the result you want.
Yeah. And always in that perspective, it's got a cash flow, or else it's cash flow in the way that it's paying for yourself. Even in the worst case scenario, it has to pay for itself, or else you're working backwards.
100%. The way I describe it is the property has to be self-supporting, right? So you invest some capital, buy a property, and maybe in that the capital, you account for the capital you need to renovate and rehabilitate the property, but you invest a certain amount of capital, you execute, let's call it your business plan on the property, whether it's single family or multifamily. And then once you're done, that property has to pay for itself. And what the cash flow provides is a buffer of protection. If rents drop a little bit, or you have a vacancy or whatever, you need that cash flow to support the property. And then essentially the property self-supporting. You don't have to put any more money into it. You're getting a little cash flow. The cash flow is growing over time. And meanwhile, the value of the property is going up. So when you think about it, you invest the capital, you don't have to put in another dime. You just let that property go 5, 7, 10 years, and you just grow your worth and increase your cash flow as you go, because rents generally follow the rate of inflation, if not more.
Mm-hmm. Yeah, it's interesting. You mentioned that we don't really anticipate the price of homes to fall. But right now, so we've got a bunch of deals that we're looking at, Arn, to refinance, and we've been holding on to them for a little while. We're seeing these rates go down, and getting called by the lenders saying that, hey, you got to do this now because do it before the property values decrease. And I'm just thinking to myself, well, that's kind of a sales pitch because the interest rates are going down. And they want to lock into these rates before the interest rates go in. So it's not as much as the property values going down. And we've seen it too, Arn, where, as the market slows, depending on what types of properties are going out, we will see a small fluctuation in that market value, but it's not like we're losing, you know what I mean?
Yeah, and the thing is, going back to cash flow, you own a rental house and say in 2021 it was worth 200,000, and in 2022 it went up to 225,000. And in 2023 it was still 225,000, and maybe today it's 215,000.
Mm-hmm.
Well, who cares if you're not selling?
Right.
And as long as the property's cash flowing and you don't have to sell, you don't really care about the value because you're not a seller. And generally what I've seen in my experience, and this pattern has been repeated, I'd say 3 or 4 times, typically in real estate, what I see is 4, 5, 6, 7 years of growth, let's call it boom. Then maybe there's a minor year or two of a little bit of correction, but the correction is always very minimal to the increase, right? Values may go up 80% over 5 years, and so they drop 5 to 10%. You're still 75% ahead. And then once the little correction happens, and I think we're in a little cooling period here, primarily due to really high interest rates. And now that they're coming down, I expect the market to take off again because there is a shortage of housing. There's pent up demand. After the little bit of dip, maybe there's a year of a flat. And as all that does is set the floor for the next 5 to 7 year run up. So the floor back in 2022 was here. Now it's going to be here, and it'll set up the next floor. So as long as it's cash flowing, you just ride out the little temporary turbulence. Like I say, a little rain must fall. So we're going to get a little rain today, but tomorrow will be sunny, and the sunny days outweigh the rainy days. So as long as it's cash flowing, the value of your investments will go up over time.
Yeah, absolutely. And there are some of those areas, I say the more volatile the area is, the faster that appreciation is running, like Austin, then you have more risk involved with losing that. So depending on your exit strategy, your conservative acquisition processes, that's it's kind of up to the investor to really take on that risk or not take on that risk.
Yeah, you're 100%. So let's just say what goes up the fastest maybe comes down the fastest. Yeah. So it's relative. And you hit on another really important point. People will come to me and go, well, where's the best place to invest, or what's the best type of property to invest in? And I always answer, it depends, because one size doesn't fit all, that every investor's different, and they have different needs. They have different capabilities, either from income or capital. They have personal preferences. And so I think it's for each investor to kind of find the niche that makes the most sense to them, that they enjoy, and certainly that risk reward calculations in it. And I would say for myself, the way I describe myself as an investor, I'm looking to hit line drive base hits. I want to hit line drive base hits 5 years, 10 years, 15 years, I'm going to win. I don't swing for the fences. I don't swing for the grand slam. Now, other investors have a different approach, and they take a higher risk deal, perhaps with a higher reward, where I'm kind of more the tortoise than the hare. And that's how I've done it, just slow and steady, let the market and time kind of really win the day for you.
I love that. And the faster you make money, the faster you can lose money. It's just like in business. The faster you build a business, the faster that business can fall apart. And in this line drive, base hit path, I love that because it's slow and low. That tempo is just that delay gratification piece. It's tough. It's not fancy. It's not flashy. To me, I hear like acquiring stabilized assets, mitigating risk. You're about capital preservation, and that value add piece is. I mean, there's maybe some tweaking in the operating that's happening, but not necessarily just completely resetting units, completely rebuilding. Massive capex. Is that correct?
I agree with that approach. So we tend to stay away from the really heavy value add. Usually the buildings are 50 or 60 years old, and you can put lipstick on a pig, but you still got a 50 or 60-year-old building. The other thing I think we're seeing is we know in the current economy, different segments of the population are doing better. And in general, the people with a little bit higher income seem to be doing better than those with lower incomes. And so we kind of like to stick to that middle income, solid bread and butter type property, not the luxury downtown apartments, but not the 60-year-old apartments that have lower income tenants. They're older. There's more deferred maintenance. So we kind of like that steady. In Greenville, our rent level that we like is about 12 to 14, 1,500. It's affordable for, let's call it, normal working people, but there's a level of stability to their economic situation that's good, where tenants often who are paying 700-800 a month rent, if they have a car repair, they're going to have a hard time paying the rent. And, we treat everybody with respect and courtesy and try to work with people, but it's just a reality. There's areas that it's a little bit easier to operate the property. And of course, vacancy and credit loss is always a big expense. So to the degree you can minimize that, your bottom line is going to be more. So yeah, we kind of like that middle of the road, right down the fairway. Moderate income housing is where we think the sweet spot is.
When you say credit loss, is that like delinquent rents that were never paid?
Delinquent rents, yes.
Yeah.
Where maybe you end up having to evict and you lose a month or two rent. So that was what would be credit loss. And I think the other thing we're seeing is, when you think about it, if you have a unit and you're doing a major reno on it, it's down and not available for rent for a longer period of time. So I agree with your approach about trying to improve the operations on the margins without having to totally rebuild the building. And as you know, it costs a lot to get contractors and work done. Anybody who's ever remodeled their house and spent $50,000 on their kitchen, they understand things are expensive. So if you can do it on an operational level, our typical unit turn maybe costs us $7,000. That would kind of be luxury vinyl plank, new paint, maybe some new plumbing and electrical fixtures. But we try to stay away from properties that really need major work.
And at that 1,200 to 1,500 kind of target rent, does that mean that you're shooting for incomes right around the 50 to 60,000?
Yes, correct. And maybe a little bit more. And you see, like in Greenville County, median household income right now is about 80,000.
Oh, wow.
So we're right in that sweet spot where there's demand and demand, but there are jobs and income that will support those rent levels. So that's exactly right. 1,500 a month rent, you should be making about 60 grand a year. And of course, that should be accessible for most people who have stable employment, right? $20 an hour job full time is 40K a year, right?
Mm-hmm.
So 2,000 work hours a year. So having rental product that teachers can afford, firemen, policemen, contractors, carpenters. There's a broad need for that. So we're happy to kind of provide that kind of housing.
And just to work that math backwards, all I was looking at is when we go to screen a tenant, if the rent is 1,500, then we're expecting their income to be 3 times the rent. So that 1,500, I need at least 4,500. Then you multiply that out by 12. That puts that 1,500. In order for a tenant to qualify, they need to show at least 54,000 in income. So we just kind of work that backwards. And if you look at the outside in approach, is like finding those areas first and then the property that fit that. So I think that's great. There's so much information here. When you say, last question I have for you, Arn, is when you say small multifamilies, what do you mean? What's that mean to you?
We tend to do so. Generally, anything 5 units and above is considered multifamily. The financing becomes a little bit different. So technically, 5 units and above would be considered multifamily. When I refer to small multifamily, I'm kind of talking 20, 30, 40, 50 unit buildings is kind of like what we like to do. Many operators talk about the benefits of buying 100 or more units. And while there may be some benefits to do that, we actually kind of like the smaller properties because it's easier to get in, acquire them, get the property running at optimal level in 12 to 18 months. And so you get in, you work hard, you upgrade this property, upgrade the rents, the income. You've now got it humming like a top. Now you go on and you find another one where if you have a 200 unit building, it's probably more like a 3-4 year process. And it just takes so long, you sometimes slip back a little bit. So we like the smaller properties you can get in. And oftentimes they tend to be in maybe a little bit better areas. You know, they're kind of next to a nice single family neighborhood. So we find the locations are often maybe a little bit better than with the really huge apartments, which often tend to be, you know, you might have 10 big apartment complexes on one street. We would prefer to invest in a more residential area, but still have the benefit of the multifamily.
That's awesome. Yeah, I feel and hear the same things that you're speaking. That 75 number is kind of like that spot where you could have on-site staff and then grow from there. Yeah. I would love the opportunity to look at anything that your team does not take on. I am constantly working to grab something here in South Carolina. So if anything does come up that does not fit your investment criteria, I'm always putting it out there in the airwaves that Brett wants a multifamily in South Carolina this year. So
yeah, no, hey, the first 12 unit building I bought, at the time was the largest. I mean, I've done deals as big as 281 units, but again, our sweet spot's probably 30 to 50. But the first 12 unit I bought, it was a result of a Facebook post. So within the local investor community, I just kept posting out, just like you say, hey, I'm Arn, I want to buy multifamily. I'm driving to the golf course one day. I get a call from a local wholesaler. He goes, hey, I got 12 units in Spartanburg. Would you be interested? And I'd said, heck yes. And we ended up buying it. So your approach is right. You just kind of spread the word. And yeah, I'm happy to send you stuff. And hopefully, since we're not too far apart, at some point we can meet face to face.
Yeah, that'd be great.
Always for me, the investing, and especially the multifamily, is a social activity. It's a teamwork. It's a partnership activity. Single family is great, but it tends to be maybe a little bit more of a solitary activity, where with
Yeah.
multifamily, it's more a team approach. So I really enjoy working with other investors. So yeah, happy to work with you and try to
Awesome.
help you in the future.
That's awesome. That's
Yeah.
awesome. And if you could go back 15 years, Arn, and you had sat beside somebody on the similar path as you, maybe in the same goals at that point, in investing, thinking kind of maybe a direction for your next 10 or 15 years, what would you tell that person if you knew not then what you know now?
Yeah. So I'm not one to have much regret. I tend to live life and I'm optimistic and I course correct as needed. Uh, but I can say I moved to the multifamily about 4 years ago. March of 2020 was when I did it. And in retrospect, uh, I should have done it earlier. And so that perhaps is a regret. It's not anything negative about single family investing because it's done very well for me. Uh, but with the multifamily, you can partner with people who maybe have skills you don't have, or enjoy doing things that you don't like to do. And so the Spark Group, it's basically a three-man team. I'm kind of the deal hunter, the investor relations person. Brian, who lives here, is the operator. He takes care of the day-to-day, which I don't particularly enjoy. And then we have Dan, who's the brain, and he takes care of all the numbers. So with multifamily, you can partner with people who have complementary skill sets and really have a solid team built. So I think I would have moved to multifamily sooner. And I'm hooked on this as an asset class now, so I'm going to continue.
Nice, nice. And
Yeah.
when you mentioned Spark, it's investwithspark.com is where the listeners can go find out more about you and your team. You had mentioned the three partners there, and they can reach out to you and connect with you. Are you guys currently raising? Are you syndicating as well too?
Yes, I'm primarily a syndicator.
Okay.
So we closed two deals back in June, new build duplexes, duplex communities, townhouse style. We ended up buying, what do we do? 18 duplexes, 36 units. I think total price was about 6 million. We raised a little under 3 million, closed them in June, and they're doing great. So I primarily do syndication. On some of the smaller deals, if we were to find 6 to 8 units, a million five, we might do joint ventures. So I enjoy doing joint ventures with kind of local investors. So I do both.
Nice, nice.
Yeah.
And that's investwithspark.com. Learn more about that. That build to rent. We didn't even talk about that. We're just breaking down the numbers there on that $6 million deal. If there were 36 doors, that puts you at about $1.60, $1.70 a unit. That really ties into that 1.0 rent ratio if you're targeting the 1,500, 1,700 range. So
Yeah,
that's
and
how about that math? How about that
construction.
napkin math, huh?
It's the spreadsheets are great, but you can make a first pass on a back of a napkin.
Yeah.
And if it passes that test, then you can devote more time and really drill down to the numbers. And the other thing I would encourage your listeners to think about, the numbers are important, but there's also a qualitative aspect to investing. The quality of the building, the quality of the location. And so pay attention to that, because at the end of the day, quality is going to win out. Those desirable areas are going to do best for you. So look at both the numbers, but also kind of the qualitative aspects of the location and property.
Nice, nice.
Yeah.
Awesome. Well, again, thank you for your time, Arn. It's been a pleasure. Thank you so much. to the listeners out there today, jump on that website, investwithspark.com, and even picking through the portfolio is really fun to see how fixed the location is and learn more about the Carolinas. Because if you're like me, you've probably heard a lot of people talking about the Sun Belt, a lot of people talking about the Carolinas, and there's information to grab here on investwithspark.com. And if you have any questions, reach out to Arn. If you have any questions for us, always feel free to hit us up. And I haven't said this in a while, but leave us a review on any platform that you're looking at. It is really helpful. It helps other people see the movement, and all these amazing guests coming on here, sharing so much information. And thank you for your time. And as always, more importantly, your attention. This is the Real Estate Mogul MD.